I think we're waiting for Kathy McKay to get our party officially started.
Okay.
Jan, I appreciate seeing you on here and realizing you just can't get away from DMTRS.
Hi, Blake. I'm on here via phone because my computer won't let me log on.
All right, let's go ahead and get started. I think today, really from an agenda standpoint, is our BTC team is here to give their full report, and so they'll do their report, and any of us members who have questions will ask away, and then that's really the only thing that we're going to work on today's meeting. So, Alan, I don't know who's kicking this off on your team, but go ahead whenever you're ready, and we look forward to your report and hearing how we're doing.
All right, thanks, Blake. Yeah, we'll work through the report today, and I'll share my screen so that makes it easier to go through. Okay, you should be able to see can you see the report?
Yep, John, you're on the screen.
Okay, John's on the screen. John, our Chief Investment Officer is with us, and you've seen him before in these meetings, and Jeff Beardsley, the head of our fixed income team, is with us as well. So I'll let them go through the report. Let me know if you can't see it, but I'm in share mode, and I'm on the title page. So we'll go past the title page, and we'll go into the compliance page, as it says in the upper left. And before turning it over to John and Jeff, I'll work through some of this detail. But the guidelines you see listed on this page are some of the detail and some of the guidelines we follow that are specified in the investment policy statement. But these are the key guidelines. So, for example, we've got guidelines here in the upper half of the page related to cash. The cash weight needs to be between 0% and 10%. And as of June 30th, it was at 1.7. So we're in compliance there. Fixed income needs to be between 60 and 90% of the portfolio weight, and it was at about 72% at June 30th, so we're good there. Very high quality portfolio, almost 58% of the portfolio, either in between AAA and single A in rating, so very high quality. Equity, the weight at June 30th was 26.7, so that's between the minimum and maximum of 30% specified in the investment policy statement, so everything's good there. And then other limitations, several key limitations here, limitations, but one of the things that we focus on is the investment in any one corporation. We want to make sure the portfolio is well diversified. And so, for example, the weight of a bond of a company plus the stock of a company can be no more than 2% of the weight of the entire portfolio. And here we have 1.9%. And I know in the past, this has been due to holding a Walmart stock plus a Walmart bond, or maybe it's a couple bonds, and that's the case here. We're at 1.9%, so we're in compliance with that as well. All other bond and stock combinations are much smaller than 2%. All these other guidelines, we're in compliance with them, and everything looks good. So nothing to note here, no asset allocation changes that need to be made because of compliance. We're in compliance with all the guidelines in the investment policy statement, something we state every quarter. Thoughts or questions before we move on? Okay, on to the next page. The table in the upper left shows the market value of each of the asset classes as of June 30th. And so we can see that cash and equivalents, and this is actually money market. It's not cash, it's money market, which is earning about 5% in today's world, up many percent from where it was 18 to 24 months ago, but 3.5 million approximately for about 2% of the weight. Taxable fixed income, 132 million. So that's the bonds, almost 71% of the weight. And then tax exempt fixed income, a very small amount, less than 1% of the weight. So altogether about 72%, between 72 and 73% in bonds, and then 2% in money market. Get you just a little bit less than 75% in money market plus bonds. And the other, as we stated on the prior page, the 26.7% of the weight of the portfolio that's in equities. Well, most of it's in large cap stocks, specifically large cap value stocks, which have high dividends. And John will get into those detail of that allocation in a minute. But $35 million, almost 19% of the portfolio, is accounted for by the large cap value stocks. So big anchor to the portfolio, driving growth in the portfolio, producing some income, no doubt, and a significant amount of income. But this is where the growth and appreciation in the portfolio is primarily going to come from this $35 million allocation. But also helping that allocation, or helping that growth and appreciation, is $5.2 million in small cap stocks, as well as an allocation of about $1.1 million to REITs, and then foreign equities, almost $8 million. So just gives you a good snapshot here of the market values of each of the components of the portfolio. And then finally, for this page, the bar chart in the lower left shows the size of the allocation at June 30th for all of the years that are shown. And so one takeaway that's easy to see is this navy blue portion of the bar, that is U.S. large cap equity. And you can see that the size of that bar has been fairly stable over time. And that's what we would expect. That tells us that the allocation is fairly stable from year to year through ups and downs in the market. And also, it gives us a sense of the risk in the portfolio. We don't want to see a lot of fluctuation in the risk of the portfolio. We're certainly not seeing it here from the bars, especially over this 6-year period. That's what we would expect. Everything is good, everything is stable. So no conclusions, no proposals or anything to draw from anything we see here. Moving on to performance, I'll let John talk about performance. I can comment too, John, if you want, but feel free to go into as much detail as you want on this page, and take it away.
Okay. Can everyone hear me? Great. Okay, so taking a look at the performance information on page 4, this is performance through June 30th. So just keep that in mind as we walk through these numbers. The top row of numbers represents the performance for the total fund, and this is total fund net of all fees. And we'll just kind of focus on that 3 months, 0.42%. So positive return compared to the benchmark, which was a -1 basis point, or 0.01 as depicted on the page. So you can see on a relative return basis, the fund has done well relative to its benchmark, expanding out to that year-to-date column, 3.48% versus its benchmark at 2.15, and for the last year, 3.29 versus 1.22. So on a relative basis, good performance compared to benchmark. And then just kind of scrolling down the page to look at the individual asset classes. Cash and equivalents, of course, that's your money market fund. The one nice thing to say about that right now is the yield has been consistently increasing on what you're receiving in the money market fund. In terms of that yield, as we've seen those short-term rate increases implemented by the Fed, money market funds have followed up that ladder of increases to where now you're getting a very healthy yield on those money market fund balances, where not that long ago it was barely above zero for a period of time, and that has changed dramatically over the last 12 to 18 months. On the fixed income side, and obviously Jeff will be reviewing the fixed income assets in more detail, but you can see the return has been very positive there relative to the underlying benchmark, which on this report is the Bloomberg, that's what BB means, Bloomberg US Aggregate Bond Index. So you can see that those bonds have performed very well relative to that index. And then sliding down, as Alan mentioned, there's not a lot of the portfolio invested in tax-exempt fixed income, which is actually misleading because it's not tax-exempt fixed income. They are municipal bonds, but they are taxable. And I think we've shared that information in the past. But the way our system looks at it, if it's considered a municipal bond, it gets put in this category, even though it is taxable. And as you can see on the year-to-date basis, very strong performance there. as well, and including the quarter. Then we get to the U.S. equities, one of the larger components of the portfolio. Once again, when you take a look at the 6 months, the year to date, the 1 year, very good performance, a little less than benchmark for the 3 year and the 5 year, but getting very close to benchmark when you get out to that inception of 9.6 versus 10.3. A little underperformance for the quarter, that 2.5 versus 3.2. Now, remember, one of the things that we have done over the last couple of years is we have put into place some small cap equities and a specific allocation to real estate investment trusts, primarily to generate additional income, particularly in the low interest rate environment that we were in for that extended period of time. Those are reflected in that performance as well. And then we have the foreign equities, which, as you can see, have done very nicely relative to their benchmark. So good performance across the board. Then once again, just kind of rolling up to that total fund, you can see once again how well it has done relative to benchmark over the duration, going back to inception to date. So with that, we can move on to individual asset class comments, unless there are questions or comments in regard to the performance page.
All right, go
Okay.
ahead, Jeff, on the fixed income page.
Right. Take it away, Jeff.
Are you on mute, Jeff?
All right. Thank you very much, Alan. All right, here we go. Fixed income, which represents around over 70% of the overall portfolio. Performance continues to be good, and yields are great right now. We were actually able to get very good yields above 5%. You can see there the yield to maturity, yield to call, 5.38% is the portfolio's book yield. That would be the yield at which, it's a good idea of where we're buying new things. What's the yield we're getting now as we make new purchases. Now, that's not the entire portfolio. The actual, the book yield is closer to around a little over 4%, but that's kind of gives a good idea of where we're reinvesting at. You can see the Barclays on average about 4.81%. That's because they own a lot more treasuries. We own a lot more corporates within the portfolio. Overall credit quality A1. That's irrespective of the recent downgrade of the treasuries. We don't own a lot of treasuries in the portfolio, so that downgrade was somewhat of a non-event essentially. So that lack of treasuries really doesn't change the credit quality of the portfolio at all. Average maturity 9.18 years, effective duration 6.13 versus the benchmark 6.31. So we're slightly underweight. In a rising interest rate environment, you do want to have a lower duration than the benchmark in order to outperform. So currently, that's providing some advantage to us. Down below, you can see the breakdown of the types of assets. One area that you'll notice there's one called commercial MBS. And of course, that has gotten a lot of news lately with all the empty buildings that you can see around town. And, we have that even here in Des Moines. If you look at Nationwide and a couple of other buildings that the state and the city have been taking over, have agreements on. So we look at those, and within the portfolio, you can see it's 0.0%. So it's a very small percentage overall. There is a small, we do have some holdings in the commercial CMBS space, but they're all rated AAA. So it's not the type of, and it's a very diversified set of portfolios or pools essentially. So it doesn't add up to a whole lot in the percentage wise, but I did want to assure you that what we do own is very high credit quality, and they are very seasoned. They have a lot of unrealized, they've been held for a long time. So the value of the buildings have a lot of accumulated equity essentially in them at this point. Corporate bonds, credit has been doing very well. We continue to see upgrades overall. across the portfolio and across the benchmark as well. And then down below, you can see the breakdown of the credit quality of portfolio. Um, Again, in order to achieve excess returns, which we've been able to do rather consistently over time, we do make bets away from where the benchmark is. You can see 72% is in AAA. Majority to about 64% of that is treasuries. So because of the smaller portion of treasuries in agency bonds up there, 3.5% versus 42.9, you can see, I said 62%, sorry, that's intermediate. 42.9% is that treasury and government area. Thank you, Alan. And so very high credit quality. You can see anything below investment grade, there's only 0.8%. Of course, there's the preferred stock from the Federal Home Loan Bank that's still held in there. And I think we have a split rated item, but all in all, we don't see any credit issues within the overall portfolio that are going to generate any meaningful loss or loss. If we expected there to be a loss, we would obviously we'd sell the security. So that's kind of the nutshell on the fixed income. Again, the highlights are our reinvestment yields are around that 4.5% area is where we're targeting for reinvestment, which is very good when you look at the liability and the payout formulas that the school district has on this plan. So thank you very much. I'm going to turn it over back to Alan.
All right, thanks, Jeff. I guess we'll go to John to talk about equities on the next page, page 6.
Okay, thanks, Alan. Yes, on page 6, we take a look at the large cap value component of the portfolio, which is second in size to the fixed income. So the most significant equity exposure within the portfolio. And I think most of you on the call are familiar with this format where you look on the left side of the page and we have some statistical information that looks at the portfolio relative to its benchmark, which in this case is a value index, because these are value-oriented holdings. And once again, as we've discussed on numerous occasions, we really focus on a couple of metrics within this portion of the portfolio. We look at valuation and we look at yield, and we want to have a valuation that's lower in the market. And in doing that part of the analysis, we look at the price earnings ratio, which you can see for the portfolio is 13.2, the benchmark at 15.3. So what that translates into with having a little more modest valuation is a little less volatility typically in this portfolio because of that. And also what helps mitigate some of the volatility is the fact that our dividend yield about 3.1% at the end of June versus 2.8 for the benchmark. So getting that cash flow coming in. And as you know, we've emphasized this strategy within the portfolio for a number of years, given where we've been with that interest rate environment being so low, having that additional income added to the potential for some appreciation has helped ensure our ability to make sure we're generating a nice cash flow into the portfolio in addition to the level of appreciation that we can realize. Directly below that, we show the sector breakdown within this portion of the portfolio. You can see as of June 30th, we had a little bit of cash there. So often that's a indication of some transitioning we're doing in a portfolio. So typically not going to be that high within this segment of the portfolio. But as you can see, very broadly diversified across these economic sectors. A little overweight in terms of technology, which has been a great place to be this year so far with the performance of that part of the market relative to other segments of the market. We also dramatically underweight in consumer discretionary, which is a very small portion of this strategy. And then pretty much market weight in financials, which you can see is the biggest segment within this part of the portfolio, within the large cap value universe. So we're pretty much right on the benchmark in terms of our positioning relative to that benchmark. And in the lower right corner, you can see the 10 largest holdings, many household names that you're all familiar with: Walmart, Johnson & Johnson, Cisco, Procter & Gamble, Exxon, Bristol Myers, etc. So mature companies still having some price appreciation potential, but also generating that very nice cash flow in terms of the dividends to help add to the return. Moving to page 7, this is the small cap segment of the portfolio. Obviously much smaller than what we see for the large cap value stocks, but making a contribution. And taking a look at the statistical measures here, once again, we do have that price earnings ratio that is less than the market, which is pretty standard for most of our strategies in terms of one of the bedrock characteristics we focus on. And then also the dividend yield, just a very small touch higher than the benchmark at 1.8%. And then directly below that, the breakdown in terms of the holdings relative to the benchmark in terms of sectors, specifically economic sectors. One of the big differentiators here is within this segment of the portfolio, we do have significantly less exposure to real estate. As you'll see in a moment, we do have that standalone exposure to real estate in general, but within this small cap strategy, we do have it underweighted there. So that's really probably the most significant differentiation between the strategy and the benchmark. And then when you look in the lower right, names that are not as readily recognizable as what you see in the large cap space, but it's a very different universe in that the average weight for any one component within the benchmark is much smaller than you see in the large cap for the most part, particularly at the upper tier. So you don't see as big a weights maybe as you do in the large cap value because the underlying holdings in the benchmark are not as large. So a little differentiation there. Moving to page 8, we go to the international equity component of the portfolio. Once again, same metrics in that upper left-hand corner, and you can see same result where we do have that price earnings ratio less than the benchmark. Not a huge differentiation, but still lower. And once again, the addition of the international equities to the portfolio a while back did help add some more cash flow in terms of dividends. As you can see, 3.1% dividend yield, just a touch under the 3.3 for the benchmark. And then taking a look at that sector breakdown directly below that, you can see in terms of major differentiation, we're overweight in materials relative to the benchmark. What type of companies are included in materials? Chemical companies, steel companies, forest products, etc. Those are typically the types of companies you'll see in that space. And then a little underweight in the consumer staples area. That includes beverages and food products, etc. That are the dominant components of that. And then once again, on the lower right-hand corner, a few names that are probably relatively recognizable within that roster. Nestle, world's largest food company. Unilever, kind of the foreign comparable to Procter & Gamble. So a lot of their products utilized by consumers here in the United States as well as outside the United States. So some very significant companies represented in that list. And then lastly, on page 9, the real estate component. These are real estate investment trusts, publicly traded real estate investment trusts, and just taking a look at their characteristics. Once again, you have that price earnings ratio less than the benchmark, but then a real departure on the dividend yield where your real estate holdings are yielding 6.5% versus the benchmark at 3.9%. So a real distinction there in terms of the amount of dividend yield that is being generated. And obviously that's very helpful overall in terms of contributing to the performance of the entire portfolio. And then finally, once again, in the lower right-hand corner, the listing of the 10 top holdings. And you can see we have kind of a diverse group. We have some industrial. We also have gaming and leisure properties, some health-related real estate properties represented there. So also having good diversification in this portion of your portfolio as we do within each of the segments as well as across the entire portfolio. So a key attribute of the overall holdings. With that, any questions in regard to the performance information we just reviewed for any of the various components?
All right. That concludes our comments. As always, feel free to route any questions or thoughts via email through Kathy. And also, we're on most of these calls every month too, so feel free to save any questions you have, and you can ask them on the call. So, if there's nothing else, we'll exit the call and leave you to your agenda.
Thank you very much.
All right, thank you.
you.
Everybody.
Okay, does anybody have anything that's further to discuss on this call?
No, I just want to make sure that a copy of that report gets sent out to all the committee members, and maybe also if we could get it to Rosie so that she could attach it
Yep.
on the minutes so that it's on board docs. Otherwise, I
Will
just
do.
want to confirm that our next meeting is September 13th. Is that correct?
That's correct. And at that time, prior to that, hopefully I will be sending out an email to you, this group regarding election and what's to be expected. We've got a couple spots that are up for renewal, and we're still short a member on the active side. So again, if anybody has anybody that they want to elect or nominate for that position, that would be great.
All right, I think we'll see everybody in a month.
Sounds
Sounds
good.
great.
Thank
Thanks,
you.
everybody. Appreciate it.
Take care, everyone.
Have a
Enjoy
good
the-
night.
Take care. Bye-bye.
Bye.
Bye.